You know it. Yeah.
Hello guys and girls, welcome to episode 3 of the Profit Playbook. In this episode we are going to talk about the entries that we have on the previous structures that we draw. Like I said on the previous episode, I've actually explained a lot of things there, so which is why I'm just going to kind of brief it in this episode so you can just go back and watch it. We have two types of setups in my trading plan. I have type A setups and I have type B setups. Now on the type A setup, I have the type A, which is the ordinary 1, 2, 3. Then we have the type B, which is the one that is having a hook point. On the type B, we have a 2-touch structure, which you can take this one around here. And on the type B plus, you have a hook point, and then you have the first point missing the hook point, and then the second one eventually take that out and gives you the entry candle, which will be one of those candles. Now, this is not the one you want to be taking. This one, you don't want to be taking this sort of entries because majority of the times it's going to take you out anyway, and I'm going to explain why. So you don't want to be taking this type of entries. Now, like I said, you can go back to the previous episode. I've explained the in-depth of these setups right there. Now this is a retrace. It has to close 50% of this previous candle, and then you take on the break. Now we're in a situation where you have both of them equal. You can take it either on the break or you can take it as a 50% limit order. Depends on what you want to take, but you have to understand that if you take it on the break, it's going to give you a kind of lesser risk reward ratio compared to when you take it as a limit order. Limit order is going to give you a very, very healthy risk reward ratio. Same as in this case as well. On this case, in this one, I would like to go for risk limit order because if you take it on the break, it is going to reduce your risk reward. However, if you take it here, it's going to give you a very healthy risk reward. But then the cons to this one is that you might not get tagged in, or it might tag you in and then it will just tag you out anyway. But however, if you set it on the break, most of the times it might open and then it will just go back without being tagged out. So there's a lot of pro and cons to each and every candlestick entry right here. Now this one is a kind of triceratops. So once you have this kind of candle like this, you can take it on the break as well, or you can take it within the weeks, 50% within the weeks. Now you want to be taking those ones that actually pierce through this value area. Suppose this is the value area right here. You want it to be pierced, same as in this case, but in a situation where it just kind of kissed it like this, you don't want to be taking those type of entries because the next candle could open and then it will fill it, sometimes even taking you out before the next the real entry signals comes in. So you don't want to be taking those ones that did not wash the value area out or just tagging it. Depends on the kind of setups though, but majority of the times you want to be avoiding this type of scenarios. If you want more in-depth about these setups, you can refer back to the previous episode, which is the episode 1. There's a lot of in-depth information about this one right there. So without further ado, let's dive straight into it. So this is the first one we're going to look into. So what we're going to consider in this one is we're going to consider the location, the time, and the type of entry that's suitable for them. Because the time and the location is very, very important. You don't want to be taking an entry when price is heading into the swap hours, so you want to wait. So that is why some entries you might be asleep while they shape up. So there's a lot of things that we have to put into consideration. We are going to do that from this one so that when we go to the backtesting session, which is in the next phase, and everything is going to be much more kind of easy to grab because already I'm going to lay the foundation on this one. So we have this one right here. Now look at that. We have this price pushing. When price tap into this value area, look at that momentum that was coming from that area, and then it exhausts and form this kind of exhaustion right there. Now if you look at the exhaustion as well, you'll see that is a kind of 1, 2, 3 kind of exhaustion, and then you will only see this more clearer when you go to 15 minutes, but we're not going to do that. As you can see, we have that 1, 2, 3, and then we have price pushing to the downside. It forms this hook point and then it drop again, which lead on to breaking of these structure lows. So the natural stuff is that we should be expecting price to come and mitigate this hook point, thereby giving us 1, 2, 3. Let's say something like this. We'll be expecting this pattern to actually lead into this hook point and give us something like this 1, 2, 3, a drop, and then we start to look for the continuation. However, it doesn't get to that area. Now, what is going to give us the kind of clue to take this trade will be this one right here. That's our mini consolidation right there. If you look at that, this one is more like a 15-minute hook point, which is something you can go to 15 minutes and look at it. You'll see a sharp move up and then a sharp move down. Now, plus the fact that this one actually missed this one, it was not taken out, it dropped. It induced a lot of people to sell from here, thinking, okay, this is going to go, but then it come back, it grabbed the liquidity, and then it pushed. Now look at the entry right there. Look at the retrace entry. Look at that. This one is more like an bearish engulfing candle, right? So what you're going to do is you're going to delete this one. Although we know it's a 4-hour structure, but we're going to use our normal trend line, which is going to be yellow, to mark out these areas. As you can see, we have this area 1, 2, 3. Now this one doesn't have depth because it's more sharper, like 1 impulse, correction, impulse, everything is more sharper. But at the end of the day, you see the momentum that leads to this area, and then we have the exhaustion again, and then we have the retrace. So there's 2 ways you can take this entry. The first one will be as a self-stop order, which is just below here. Now let's look at that. Then you're going to have your SL just above here. Now there's many ways you can manage this trade, but let's use more mechanical ways to manage this trade. You can set your take profit right there, but there's another way you can do that, which is using the 90%. So you're going to set your take profit around the 90%, and the 90% is just going to be there. So now the first entry will be as a self-stop order, where you have your order set immediately after this one close, few pips below there. Then as you can see, you got tagged in, and then you got out of this trade for 3.3%, which is not really bad. However, like I said, there's a way you can capitalize more on this type of positions, which will be using the limit order. So using the limit order, you're going to have it at 50% of that at the close. So it's going to be here. Then your SL, your stop loss is just going to be a little bit above there, and then to same target, that will be 5.84. You see the difference? So that will be the first trade. Now let's look at the time of entry. The time of entry is actually on Thursday around 2 o'clock a.m. Now this is the type of scenario where this trade, you would have, a lot of people wouldn't have take this trade unless you are in this from Australia, or maybe Australia, so to speak, because this is actually Australian session. This is Australian session. So that is the Sydney session. So there's a lot of people like us in Nigeria would have been asleep by then, even the UK guys. And then so this one is actually a Sydney session where a lot of people would have missed this position. However, if you did take this position, look at that as it drop, you can trade your SL to this point. You can lock in 1.62. Now there was another entry right here, which is going to be a scaling if you take this entry. If you did not take the initial entry, then you don't want to be taking this type of entry as the first entry. As you can see right there, so it actually broke this low. It's not trading through the low, it dropped, and then it's a kind of two touch. Because it's a two touch, that is why you don't want to be taking it as a kind of first entry. However, if it's a three touch after the break of low, then definitely you should be taking that kind of entry. So suppose you you took this one, and then this one is not shaping up, you can now take this one, thereby moving your SL a little bit more, locking 2%, and then when you take this position, you put your SL there, and then to the same target 2.6, and then at the end of the day, if you actually look at both of them together, as you can see, you have 5.8 and 2.6. that is literally like 8%. So that would be the first entry that we got right there. So after the entry, we have this area, look at that, and then price actually came back. It near misses this area, at this point we're actually anticipating this one to come and take this one out, give us that retrace, and then we can take the sell. Because look, we have this bottom right here, and overall price is actually moving to the downside. As you can see, tap this area, it drop, give the continuation, it drop again, and overall price is still moving to the downside. So it's normal for us to continue to look out for sell opportunities, and this one would have been one of those scenarios where we're expecting price to come to the upside, like something like this, take it out, give us a retrace, and then we would have take the entry just like this, because it's normal. This will be more like a type B plus setup, but however we didn't get that, which is okay. You move on to the next one. Now this one is actually within this area. Now at this point, as long as price is cheap trading inside of this pattern, you are still expecting this to come up to take that out, because look, this one a little bit take this one out, more like equal. So you'll be expecting this one to come and watch both of them out, giving us the retrace, and then we can get the sell even around here. So which is why you are not going to be taking this one, because it's not the highest, like it's valid, but it's not the best setup that you want to be taking. So we are expecting this one to give us that. As you can see, we drop. Now there was another entry right here, which is going to be on the 15-minute, but this one is not going to be the one we are going to be taking, and I'm going to explain why. We have this entry right there, as you can see that's more like a 15-minute continuation, but the location, this one is trading at the low. This one is not trading through it. This one is more like trading on it, right? There's difference between trading through the low and trading on the low. Suppose we have this same setups like this, and then it's something like this. As you can see, this one is kind of trading through the low, this one is trading on the low. So you don't want to be taking entry that is trading on the low, especially with the fact that this is not the first, this entry right here is not the first flag. This is within it. The move has already been initiated long ago. Look at that. There's a lot of, look at that. Everything can just be part of the squeeze, because the price is actually squeezing to the downside. This is not the best impulsive phase where you have price moving like drop, correction, drop, correction, drop, correction. This is more like a powerful impulsive phase. Now with what we are having here, this is not the best impulsive phase. Look at that. It's more like squeezing, and this can be just type of reversal, and then before you know it, you might take this entry right here, and it will just be part of stuff like this to maybe come back and retest one of those areas. We don't know, but because of that, having that in mind, that okay, we are squeezing to the downside, it's not the best impulsive phase. I don't want to be taking this type of entry, especially if it's now trading on the low. I mean, it's not something you want to be taking. However, around this area, let's look at the first one that we have right there. Now let's tweak this one initially, because this is what we have around here. Now we are looking at this. Price is now further down, so you don't want to be taking anything too touch, because of the way price has moved. You want to be taking the type A setups or type A plus setup. So definitely we're going to be looking for type A setup. Now you have this one. You have 1, 2, 3. This one do have a middle section, which means it has depth. This one did have depth, as you can see that. And after the depth, what happens? It has the 1, 2, 3 finish as well. As you can see, 1, 2, 3. And then after that, we have the third touch around here. We have the third touch, and then we have the retrace. Now, in this scenario, look at that. Our first target is going to be down here. Our first target is going to be down here. Now, if you take this entry, let's look at where it closes. If you take this entry right there, and you have your SL around here, look at that 1 point to our target, like 1.8. You don't want that to be happening. Now, if you now take a limit order, let's see that. You now take a limit order, and then you have something like this, puts it around there, and then to our target will be like 3.8. Do you want to be taking this? Let's suppose we set our order like this. Initially we're not even tagged out anyway, but 3.8 to that area, knowing that okay, we are just playing this little range for 3.87. I think is normal for us to kind of, okay, 3.87 to this range, that's okay, we can afford that, we can take it. But in this scenario, it doesn't actually take us in, then it just drop, and then this entry would have been 4 o'clock on Monday. Yeah, this is something we would definitely would have been looking at. So however, we didn't get that, and then we start to notice the way price is moving to the downside. Okay, you know what, price is not progressive, is not progressing from here, so it's actually giving us the kind of a reversal that okay, we might still go up to the upside, especially with the fact that we have this hook point right there. We have this hook point right here, and price giving us this type of price action. That is giving us an indication that we can come back to take that out, and that is now where we can now evolve this pattern. Once you evolve the pattern, as you can see, we'll now have a more like another version. We can now delete this one because it's not important again. Now what we're now focusing on this 1, 2, 3. We have this 1, 2, 3. We have these bottoms, we have this middle section. I will more have like 1, 2, 3, and then where is the entry coming from? This one, there's no entry right here, as you can see, no signal, but around here when it break back inside. So definitely there was an entry right here. There was an entry right there. So our first target, let's say we target this place for the first, take profit, which is 4.2, then our final target will be 6.6%, which is okay. Now with this entry, this one is a little bit tricky. Look at that, it actually moved out of the structure, and then it gives us the entry outside the structure. This is not something we want to be taking as well, because we want our entry to be inside within the structure so that we can have our asset placed around here. So the best thing we can do in this scenario will be to wait for this push. Once we have this push, we can wait for what we call insurance entry, which is another, maybe in this case you can now take the type B setups, because this will be the first flag, then the first impulse, the first flag, type B, any type entry will be entertained here, either type A or type B. Suppose we have a type B setup, then you can take it like this, then you can target same target area, which is 4.5, and that would be great. However, if you didn't get type B and you instead get type A setups, let's say something like this, you can still take the entry around there, still have your stop loss around same place, and then will be 4.7. so that would be how you kind of approach this type of setup. Why? Because this one has now break. Because if you take it, suppose you take it from here, it could be part of something like this, and then before you know it tag you in and tag you out, and prices around here. So you don't want that to happen, because it has closed outside the structure that we are looking at. So the best thing is to wait for pushback into the structure and wait for that continuation. Type A, type B setup can be entertained around this area, then you take the trade. Now if you look at the entry again, let's look at the time of entry and see if it's something you would have even taken anyway. Suppose you did want to take it, the time of entry would have been 08 AM. Okay, that is 09 o'clock, that is 9 AM in the morning on Friday. Definitely you'll be looking at this trade, but like I said, it's not something you want to take because it has broken out of our area. So let's go to the next one. The next one will be this one. What do we have? We have this area, we have this gap, and then we have this kind of play that is going to induce a lot of people to start selling, fear of missing out. They enter around here after this rejection. Look at that, they enter after this rejection, they got tagged in, they got tagged out. The best thing to do is to wait for push, break of this low, and then anything below here, below this low, you can now take it. In this case, anybody that's fearing of missing out and rush into the trade because they see this kind of rejection, they got tagged out for a loss. And then again, if you do that around here again, you got tagged out for a loss again. The best thing, wait for that push, breaking all those lows, and then anything below here, you can take it. So what this is actually forming, you take this one out, it push back inside, so it doesn't actually move from there. You take it off. What happens again? It comes 1, 2, you take this one out, it push back, start pushing up again. This is not relevant, you take that off again. Now if you look at the initial one where it was gapped, look at that, it gapped, and now it now came back, washed everything out in the form of what? We can now use our normal 1 hour, because this is something we're definitely going to be looking at. So you have something like this, which is 1, 2, 3 ascending formation, and then what's that? That's the reversal. We have the hook point right here. As you can see, price actually violate this, it washed everything out, and then it washed back inside. Now this is the type of scenario you want to be taking the type B setup, because this one is actually a type B setup. So this is the type of scenario you want to be taking the type B setup, because why? The positioning is early on in the move. Like I said, you want to be taking it as a first flag. As a first flag is the best. Then for a second flag, if you're going to take it as a second flag, you want it to be backed by solid momentum. You don't want to be having something like this, something that is squeezing like this, and now you now see a kind of type B setup and you want to be taking it. No, you don't want to be taking something like this. Look at that, because this thing can be part of the squeeze to now go to the upside. So you don't want to be taking something like that. If you're going to take a type B setup that's going to be second flag, you want it to have a clear momentum. Let's say you have something like this, you have normal entry continuation, you see another impulsive drop, and now you now start to see type B setup. Now if you look at this area, now this is defined. You can take it as a second entry in this type of scenario, but only 1 hour entry. But in this type of scenario where it's just squeezing, and you now see a type B setup, you don't want to be taking it. You want, if you're going to take a second type B setup, you want it to be very, very impulsive, which is something that the trade that I took on gold last week. It was a type B setup, but it was very, very defined. So that is the type of type B setup, either for the first one or for a second one, but it has to be backed by solid momentum. That's that. So in this case, this is the first flag. As you can see, we have the bottoms, we have price comes, and then it gives us the retrace. As you can see clearly, we have the retrace. That's now when you can set your order around here. Then you can now have your SL just a little bit above there. Now when does this order shape up? It was around 8 a.m. in the morning. Again, London session. This is the type of trade you definitely would have taken. Your first target will be around here, because even taking this entry, you're anticipating it that it is going to come all the way to this down, which means your overall target will be around here, which is 15.8, but your first target will be just 5%, which is again very, very healthy, because if it begins to drop, all you have to do is to keep on trailing until it eventually stop you out. But in this case, when price was trading around 2.6, definitely I would have logged around 1% on this one, and then eventually you got stopped out for 1% profit again, which is okay. 1% profit, that's not bad. You get, so this is, you have to appreciate those little profit, because at the end of the day they are going to add up. You might take 1% before you know 1% have add up to become 5%. You get, it's not that you are going to be targeting 1%, but if that is what you get, then that's fine, because this trade, this is the type of situation that the flip doesn't even work out. This one doesn't work out, because if it's going to work out, definitely it should have been going down where you capitalize. This is a trade that doesn't work out. On a normal, you would have taken a break even, which is why I don't want to take some specific type of entries. They call reduced risk entry, because if you take the reduced risk entry on this one, this would have definitely be a break even position. But because of the type of entry that we take, it gave us the ability to capitalize on this trade for like 1.21% or whatever, right? So this is the thing you want to be doing, and the reason why you manage to that area is because it has cleared this low. So you want to be locking profits around this low. You can give it a little bit space, which is something that we did like here, and then you take out for 1% profit. Now what happens again? Price failed to push to the downside, it came back up, and then what is this? It washed out others again, and then it gives this one, it retraced back and then give this impulse again. Now if you look at this impulse, we are now trading below this one again, as you can see there. There's definitely a 15-minute entry right there as well, and this one is going to be a type B setup, as you can see. Let's go to line. Look at that, more like 1 2 3. This is going to be a type B 15-minute entry, which is going to come like this. You're going to have your first point around there. On the 15-minute, this will definitely be a very, very clear structure. So let's say after this one, you did have the entry around here. Let's say you have the entry around there, and then you have your SL just above there. The entry comes around 2 o'clock on Friday. That is New York session. By the time it was down here, you definitely moved to break even. Now it comes back, it fails to, okay, you are still on the trade, it comes back here and it begins to come to the upside. Definitely this is a position you would have still logged. Let's say when it begins to come to the upside and begin to do something like this, okay, there will definitely be a break-even position if you ask me, because around this area it's as if it's going to give another entry, because we still have a lot of space to cover, which was going to be down here. We still have a lot of space to cover, which is going to be around down here, and then at that time you'll be looking at something like this, even waiting to take another entry. It's more like a type B, you can call it type A, but me I'll call it a type B, because this is the first point, this is the second point. We have that retrace to our first target. This is the type of scenario where again you utilize the the limit order, the 50% limit order. Take it like that. You have your entry around here. But that time, this is your first position is on break even. Then you have your SL just around there. So the first point again was like 3.4%. If this place does work out, this is a position where you would have capitalized like up to 7 to 8% from. But in the end, you got tagged out for a loss on this one, and you got tagged out for a break even on this one. Again, you move on, which is okay. So you take a win here, you take a break even here, you take a loss here, which means you are still 0% in profit right now. Going back to the downside, we have this 1 2 3. This is not the type of scenario you want to be taking. This is not, I want to call this one type A or type B setup or whatever. This is not the type of position you want to be taking. And now if you actually study the way price is moving to the downside, now we are pushing, we push down, we have this push up, we push down again, we aggressively push up. This now gives us indication that, you know what, this is in a kind of correction. This is not an impulse, because a normal impulse will be going with high momentum, but this one will push down, will push up almost 50% or sometimes over 50% of that. As you can see, we push down, we push up, retrace, we push down, we push up. So this is now giving me indication that, you know what, this is not an impulsive phase, this is a corrective phase. But because of that, if I'm going to be taking anything on this within this area, I want a solid 3-touch type A setups or type A plus setups. So there's nothing like I want to be forcing a position, because I understand the way price is pushing down, pushing up, pushing down, pushing up. That is a corrective phase. So definitely I want to be careful in that type of situation. So I'm not going to be taking an average position. That's what I'm saying. Now if you look at that, as you can see, this turns out to be a corrective phase. Because of the way price is actually squeezing to the downside, that gives us perspective that this is definitely a corrective phase and not an impulsive phase. So now in that scenario, I'll be anticipating that, you know what, since we have this first, second, this could be a potential 3-touch that will come inside this area. And then if that is going to be correct, then definitely if there's any entry that is solid, we can actually look to capitalize on it to the upside. Like in isolation, it will be more like a reversal pattern, as you can see. Because in isolation, it's more like a reversal pattern, like price is squeezing to the downside. So definitely we're expecting an impulsive run to the upside. Now, what gives us more clue is that look at this area initially that we had, more like a hook point. Now price actually correctively move into this area, it gives us that first impulse. Now it gives us this impulse, it left a footprint, which is a hook point, and then it aggressively pushed from that area. Now price now came back to that area again. We can now delete this one and see, okay, what did price do? We have our top around there, we have our bottom around here. This is more like expanding formation into this hook point. Look at that, we expand into the hook point, and again we have middle section on this one, as you can see right there. We have middle section, we have the middle section around here. Now the thing is, with the way price has impulsively dropped to this area, you don't want to be taking any entries around here. What you would initially would have planned with, okay, you want a pushback inside and you wait for that insurance entry, like a type A or type B setup inside that, because of the way price has aggressively moved to this side. But what happens, price now kind of push back. Look at that, it's push, it break everything, it push up and then begin to correct. Now when you begin to have this squeeze on the 15 minutes, it's going to give you a more like a descending pattern. So the best thing you can do is to take your entry on the break of it, which is around here. Then you have your order, just your stop loss order below here, and then eventually you would have taken the trade like that, and then it will tag you in. The other way you can take this trade is after the closure of this big momentum. You can either take it as a sell stop order, like I said, they have your SL just below here, or you can take it as a 50% limit order. In this case, if you take it as a 50% limit order, this is a situation you won't have got tagged in on this trade. So let's say you take the entry around as a stop loss order, a self stop order, to your target will be, you can trail the stop loss, as you can see, trail within the string points, and then eventually to your target will be, let's say 13%. You get, so this is a, you take a minus 1% loss, 1% profit, and then you now take a 13% profit on this one. Because if you're going to manage this one, you want to be trailing it after a string point. Like in this scenario, you actually trail it to around log 2% around this area. Now when it forms this one again, you log another 5.5% around this area, giving it some space to breathe. Now once it impulsively move around here again, you want it to impulsively move around those areas, it come back down, and then it impulsively is now trading around this area. So what you can do is that you can lock in something like this, because now price is around this area. If it's going to come back down here, in fact if it's going to come back anywhere here, you don't want to be on the position again, but eventually you take your profit out and then you banked right around 13.4% from that position. So that is how you would have taken that one. Now price now give us something like 1, 2, 3 into this hook point. Now look at the momentum that was coming from that area. So definitely you want to be looking at this position. You have the first flag around here, which is not the best, and then you have the second flag. Now with the second flag, this second flag, the sequence is not the best. The sequence, you don't want to be, because this is early on in the move, you don't want to be having something as big as this kind of stuff around here. So because of that, this is not the type of entry you want to be taking. The best way to actually know this is this. We can use this tool, 3 zone, then you can have it like this. We are still on the green zone. On the green zone, you want a little corrections. If you want to take this type of bigger correction, it will definitely be around this amber zone, or perhaps around this red zone. Because why? The momentum is supposed to be strong around this area. So if the momentum is going to be strong, definitely you're going to have a little correction. Now look at that. When it did come back up again, if you want to use same logic, when it come back up to form the double top, now look at this area. Look at this area, small, small. Around the amber, it becomes big. So you want small continuation. This size is not the size you want to be taking early on in the move. So definitely the best thing you want to do is to wait for insurance entry, which we did get. The best thing you want to do is to wait for insurance entry. And the insurance entry is more like a type B setup, as you can see that. You take it after this retrace, and then it tag you in, then it tag you out for a loss as well. And this trade 5 o'clock Thursday, definitely you would have taken this position. You wait for insurance entry, you have that push down, continuation, take you out for a loss, which is okay. Now after that, moving to the next one, price failed to commit to the downside, came back, take out this order in the form of 1 2 3, which is ascending formation, and that is an indication of a reversal. So again, you have the first flag around here, which is not the best. You have the second flag. Now with the second flag, this one is a bit tricky, as you can see. Let's clean that off, because essentially you have something like this. You have something like this. Now in this type of scenario, you have a retrace order. Look at that, that is a retrace entry. But then, which is why if you're taking these entries, sometimes you have to check 15 minutes to see what is actually going on, because with 15 minutes you're going to see some hook points that is on the 15 minute. If there's any 15 minute hook point, that's the type of situation you want to be waiting for it to be mitigated. Now this is not a clear run. As if you see this run, we have a drop, we have this sharp move, this bull candle, and then we drop again. This bull candle is definitely a 15 minute hook point, but because we cannot go back to 15 minutes around this area, so yeah, we're going to leave that. So if you look at it like this is going to be a 15 minute hook point. Now price now form 1 2 3 into that 15 minute hook point. Look at that, this is going to induce early sellers to sell, and then it tag them in, and then it tag them out. It take out this liquidity, it drop with this strong retrace. Now look at that strong retrace. Now because of the length of this, of the size of this entry candle, you want to be taking it as a limit order, which is something I'm going to do like this. As a limit order, and then your entry is going to come around this area, and then your stop loss is going to be just slightly above that area. And then as you can see, if you manage it the same way, you want a streak point, so you manage just closely lock 3.4, then you have another streak point, a lock 4.9, and then by this time price has actually, look at that, price now break, because this is what you'll be seeing, anticipated that it is going to come back up, waiting for 1 2 3 entry. But then look at that, it left a wick, it dropped, and then price start to come back again. This is where you want to be a little bit aggressive and be like, you know what, either you close your 4.9%, or you can just say, let me see, 7%, this is okay, let me close this position, and then you close it for 7% if you don't want to be greedy, which is why you don't want to be greedy. With these setups, the average risk reward ratio is 3 to 4, sometimes you get 5, those are the average. Now in a position where you're now getting 7%, definitely you want to be closing it, especially when it's doing something like this. But if you want to be a little bit lenient, because look, 1 2 3, it dropped, this pattern now has complete. If price is now coming to the upside, it should definitely be coming to this hook point right here. So because of that, you know what, I'm going to capitalize on this position. If price come to this hook point and give me another entry, then I'll capitalize again. So which means you might just decide, maybe around here is where you make that decision, you close this trade for 6.6% again, which is okay. After that, price left the hook point, and then look at that, look at look at how impulsive this thing is, which is something I'm saying. Impulsively drop, convincing price action, impulsively drop, convincing price action, left a hook point, target, And then this again, this is a 15-minute entry here, but since we are not going to talk about that, we're going to ignore it. But trust me, that is a 15-minute two-touch continuation right there. So price dropped, left this hook point. Is there any solid entry on these areas? There's no solid entries around this area, so we're going to clean that off. Now, what we're now looking at is this area. Price now dropped. It now forms more like a double top. When we're looking at that, it forms more like a double top. It forms this hook point. Now, look at that momentum that was coming from that area. Even the second point, look at that momentum. And then after that, what happens? There's no entry here. Like I said, you don't want to be taking. Look at the way it begins to squeeze. You don't want to be taking a kind of low quality setup right. You have to wait for a more solid structure, which is something that we begin to have right now. Because if you look at the structure, we have these points, we have this one. So like I said, you want to be using the top one. Look at that momentum that was coming from that area. Price came, it gaps that area, and eventually it takes everything out in the form of 1, 2, 3. It came back in the form of 1, 2, 3. It dropped, and then what happens? It creates these 3-touch type A setups, as you can see. This is going to be your entry again, which is something like this. Now look at that. It dropped. As you can see, it dropped. Now it gapped this area, but if you go to line chart, you'll see that is a clear impulsive run. So now, because of that, we have the hook points 1, 2, 3. It dropped. Price trading through the low. As you can see, it's not trading on the low, but through this low. So that is definitely the kind of entry you want to be taking. Now look at that. You have this retrace right there. Let's say we take this one as a sell stop order and not a limit order. You have your stop loss just above there. So what happens when price was here? You create this swing. Let's say you lock in 1.9, giving it some space. What happens again? You have another entry right there. But this is more like a 15-minute, because on 1 hour there was no entry. On 1 hour you can't enter the trade because the entry, like, look at where it closed. So when you see this type of aggressive movement, you want to be locking it. Me personally, I'll lock it around 3%. Then eventually we actually take out the low, which is around here again, for 6.7%. This type of situation where I might just decide to close the trade manually, because why? We are trading on the low, which is the 90% of the whole structure. We're not trading at the low of this whole structure. So definitely that's where I want to be closing the position, because around there, forget the fact that it's actually work out from here. Hindsight is beautiful. Forget the fact that it works out from here. In most cases, you definitely see a kind of deeper pullback or maybe deeper correction around this area, because it's not trading at the low. For price to push that back down, we need a solid correction. So which is why around there, definitely I'm going to close that position. No cap. Essentially, this is supposed to be a continuation, but because of the momentum of price of the higher time frame structure, that is why price actually tagged this area and still begin to drop to the downside. Around here, we have the 1, 2, 3. We have the hook point here, which is missed. But then what we do have again here will be another 15-minute hook point, which is taking. And then in this type of scenario, you have 1, 2, 3. As you can see, we have 1, 2, 3. You have the retrace. You can either take it as a limit order, which is going to be 50% around here, and in that situation you won't be tagged in on the trade. You can have your SL just above here. In that situation you won't be tagged on the trade. However, if you did have it as a sell stop order with your stop loss, let's say around call it around this one to cater for this high, then definitely the reason you are taking this trade is not because of anything. because we have taken out this 15-minute liquidity point right here, which is now making a type A plus setup. However, if say we didn't have this one right here, if we didn't have this one right here, you want to wait for price to take out this one before you look for the entry. So in this case, let's say you take it as a limit order, and then you are managing it just the way we've said earlier. Then around this area, this is where you would have got stopped out on the trade. Let's say you have it around here, cater for this area here. Look at that swing. We have this mini continuation. Definitely you want to be locking it around there, because this one is a continuation. This is not a hook point, although price can still come back to that area, but because of the way we have moved, definitely I'll be expecting something bigger around this area. So because of that, I might even decide to close it around here as a 6.6%, because with this momentum, definitely I'll be expecting something like this, which is something that happened. Because look at that move in one day, and then which is something that I did on gold on my last week trade on gold. I actually missed out on more positions because of this same idea, which is profitable. Look, I make 6%. I don't care if price goes again. At the end of the day, I'm still going to make profit. So that is that. I would have closed this one minimum around, let's say, call it 5.99%, and then that is another positions right there. There's actually a scaling, but we're not going to talk about that. After that, what happens? We left a hook point. As you can see, price now formed 1, 2, 3. It gapped that hook point a little bit. So definitely this is not the type of entry you want to be taking, because why? With this gap, you might take this entry, though definitely this one would have been a break-even position, but then in some cases it might tag you in, tag you out right away. So you don't want to be taking that. This is a more type A plus setup, but because of the fact that this is not mitigated, you don't want to be taking it. So definitely you are going to avoid that kind of position. Like you can evolve it. Then you have your new structures like this. You have your new structure like this, where you have this hook point 1, 2, 3. You're waiting for price to give you that entry right here, but as you can see, we broke, so there was no entry right there. Price came back, there was no entry, there was no entry, there was no entry. If you look at this, price has now taken out this liquidity in the form of 1, 2, 3, and now it dropped to the downside, which is an impulse. And then what happens again? The continuation, there was no entry around there. It created this point, it gapped it. Essentially, you'll be waiting for this one to come to this area so that you can take it. You'll be expecting something like this, but then it doesn't give us that. It instead drop again. Now this is what I'm saying. Now look at how price impulsively break this zone, this low. Now if you look at, apart from this, the one that okay, price was a little bit squeezy around this area, but when we broke the low, we have that direct move, we have that push, we have the direct move again, and that is now when we start to have this two-touch type A setup. Now this one is not the first one, but because of the momentum into this area, because of the fact that we tagged this area, we squeezed, volume was built around here, it was now being distributed. Look at that, impulse correction, and the sequence again. Because of the sequence, you have a bigger kind of continuation right here. You are not expecting the next one to be big, because if this one should be a bigger continuation, let's say you have something like this, then you begin to have something as big as this. That's now a squeeze. That is something else. That is not indicating that, you know what, we might turn from here. But because of the fact that we have this bigger one, and now we are now having this one below there, definitely this is a trade I would have entertained because of just what I've said. Because when you have something like this, you have a push down, then you have a kind of big continuation, you want the next one to be smaller. Because why? Because volume has been built here. If volume was built here, then with the momentum of that volume, this one, the next correction is going to be smaller. But the moment you begin to have something big, as you can see, that is a squeeze. So that is just the logic you're going to use here. We have this big one, we have push down, small one, push down, big one, push down, another small one, and in this case it was a type B setup. So definitely this is the one I would have entered. Now forget about hindsight. If you understand the price action well, definitely you would have taken the positions just right around here, and then you have your SL just above there. Then when price was 3%, I definitely would have locked in minimum 1.3, or let's call it 1%. Let's call it 1.2. There's enough space for price to breathe. Then eventually you got tagged out for 1.2%. Again, that's fantastic. One was this. There was no entry. Was this? There's no entry. Okay. Now what happens here? Which is the current price action. We're going to play that. Price moved down, left this hook point. Now, like I said, price left a gap. This gap, they usually got filled. Let's say you're expecting this one to fill it. That's not when we get our entry. But it left a gap, left a gap. Eventually, it got filled around here. Look at that. It got filled around here. It pushed to the downside. It broke this low. Now, with this type of momentum, this is actually an entry again. This is more like a type B plus, heading towards the lower end of type A entry, but the type B, as you can see. We have this point, we gap that area, we eventually take that out, and then we get this entry right there. So all you want to do, take it on the break on this one, have your SL just right there. By the time you're out of this position, this is the shrink point. You want to give it some room to breathe. Definitely you would have got out around 4% from this position. Then what happens? It squeezes back up again, it drops. Definitely this is not entry you want to be taking. Now with this one, if you're going to take this current entry, if you want to take the current entry, you want to take it from around this area, but now price is now trading outside the structure, so definitely it's not something you want to be entertaining. So guys and girls, these are the entries we have on the setup that we marked. We have several entries. I didn't count them, but if you do count them, you're going to understand that even despite the fact that we do take some losses, we avoid some trade, at the end of the day we still make profit from this position, overall position. So that is how trading works. You're going to take losses, and then when you're doing this thing, you have to be honest. You have to be like, okay, this entry I would have taken it. Then you can consider, okay, different way you would have taken it. If it's a loss, it's a loss. The fact is the entry is there. Hindsight is beautiful. Maybe you might try to avoid it because you see that, okay, this one does not play out, but you have to take it because that gives you deeper understanding of how price action works. You don't have to win 100% of your trade. You can win 50% of your trade and still make money from it. So that is the mindset you guys need to be on.